What if an entire continent slowly began to run out of money? Not because of corruption, not because of reckless kings, not because of market bubbles, but because the metal itself started vanishing. What happens to an economy when the very substance that gives money value simply disappears from the ground? When mines fall silent, when trade drains wealth eastward, when disease wipes out workers, and when every coin in your pocket depends on something that no longer exists? Would prices rise or collapse? Would kings lose power or seize more? Would ordinary people even understand what was happening to them? And if silver could vanish once, could money itself mutate again? This isn't just a story about medieval coins. It's a story about power, panic, innovation, and a financial transformation that reshaped Europe forever. There was a time in European history when the economy did not crash because of speculation or banking fraud, but because silver, the metal that backed nearly every coin, began to grow scarce. To understand why that was terrifying, you have to go back to the collapse of the fall of the Western Roman Empire. When Rome disintegrated in the 5th century, its vast monetary networks fractured. Gold coinage largely disappeared from daily circulation in Western Europe. Trade shrank. Cities contracted. For centuries, much of Europe functioned on localized exchange and fragmented authority. But by the 10th and 11th centuries, something remarkable happened. Population increased. Agriculture improved. Trade routes reopened. Markets expanded. Europe began rebuilding, and it rebuilt not on gold but on silver. From the 10th through the 13th centuries, silver coins became the backbone of the European monetary system. Kings and regional rulers minted pennies, deniers, pfennigs, small silver coins stamped with authority. These coins were not symbolic. Their value came directly from their metal content. If a coin had silver, it had value. If it didn't, it was worthless. That meant the money supply depended entirely on geology. Silver had to be mined. Important deposits existed in the German lands, in parts of France and England, and especially in Bohemia. By the late 13th century, the town of Kutna-Ora became one of Europe's richest silver-producing centers. When mines produced abundant silver, coinage expanded and trade flourished. When mining slowed, liquidity tightened. There were no central banks, no paper money, no emergency stimulus. The volume of money circulating in Europe depended on how much metal could be dug out of the earth. For a time, the system worked. The 12th and 13th centuries saw a commercial revival. Trade fairs in Champagne connected northern and southern Europe. Italian city-states like Venice and Florence expanded Mediterranean commerce. Feudal dues increasingly shifted from payment in goods to payment in coin. Taxes depended on reliable currency. Silver became the bloodstream of the European economy. But Europe did not exist in isolation. It traded with the Byzantine Empire, the Islamic world, and increasingly with Asia. Spices and silks flowed westward. Silver often flowed eastward. Over time, significant quantities of European bullion left the continent through trade imbalances. Meanwhile, mining productivity was finite. The easiest deposits were exhausted first. Extraction grew harder and more expensive. Output slowed. Then catastrophe struck. In 1347, ships carried a plague into Europe. The Black Death would kill between 30 and 50% of the population within a few years. Entire villages vanished. Labor markets collapsed.
Agriculture declined.
Mining operations faltered because skilled labor simply was not there. Silver production fell at precisely the moment flexibility was needed most. What followed was not immediate inflation, it was contraction. With fewer people, demand in many regions fell. Prices dropped in some areas. Tax revenues declined. Rulers dependent on silver coinage faced fiscal crisis. In a metallic monetary system, contraction is brutal. If coins vanish and no new metal replaces them, trade freezes. Credit tightens. Debts grow heavier in real terms. Deflation increases the burden on borrowers. Medieval rulers responded in the only way available to them. They manipulated the coinage. One of the most infamous examples was Philip IV of France. Facing expensive wars and fiscal stress, he repeatedly debased French coinage, reducing the silver content while keeping the same face value. The crown would recall old coins, melt them down, and reissue new ones with less silver per unit, profiting from the difference. On paper, the money supply expanded. In practice, trust eroded. Merchants raised prices. Savers lost purchasing power. Wage earners suffered volatility. Debasement offered short-term relief but long-term instability. Yet rulers across Europe adopted similar tactics. Scarcity forced experimentation. And out of that pressure emerged something revolutionary, not from kings, but from merchants in the 14th century. Italian trading powers like Genoa and Florence refined a financial innovation that reduced dependence on metal: the bill of exchange. Instead of physically transporting silver, merchants deposited funds with bankers and received written instruments payable elsewhere. Money became a claim, not just a coin. Settlement relied on trust between banking houses. Power began to shift. Banking families extended credit to monarchs and financed trade across borders. When England's Edward III of England defaulted on massive loans in the 1340s, major Florentine banking houses collapsed, triggering financial shockwaves. Financial abstraction reduced dependence on silver, but it introduced counterparty risk. Scarcity had forced innovation. Innovation created fragility. By the end of the 14th century, Europe's monetary system had become more complex. Silver coins circulated locally. Gold coins began reappearing for large transactions. Credit instruments facilitated long-distance trade. Money was no longer just metal. It was evolving. And with that evolution came a redistribution of power, from landholding feudal lords to urban commercial elites. The crisis had not destroyed Europe. It had transformed it. Just as Europe adapted to silver scarcity, history delivered the opposite shock. In 1492, Christopher Columbus reached the Americas. What followed over the next century would flood Europe with more silver than it had ever seen. Spanish extraction from mines like Potosi and Zacatecas in Mexico unleashed tens of thousands of tons of bullion into global circulation. The scarcity that once strangled medieval Europe flipped into abundance. The result was the 16th century price revolution. Across Europe, prices rose dramatically, quadrupling in some regions over the century. Inflation eroded fixed incomes. Debtors benefited. Governments saw nominal revenues rise. Once again, metal failed to guarantee stability. When supply contracted, Europe experienced deflation and paralysis. When supply surged, it faced inflation and purchasing power erosion. These two episodes revealed the same structural truth. Money is not stable simply because it is metallic. Its stability depends on supply dynamics, institutions, and trust. Metal can anchor value temporarily, but it cannot eliminate shocks. Fast forward to the 19th century, when nations adopted the gold standard. Currencies were once again tied to metal. Yet even then, banking systems layered credit atop gold reserves, multiplying claims beyond physical bullion. Eventually, the constraint proved too rigid. In 1971, under Richard Nixon, the United States ended dollar convertibility into gold, fully embracing fiat currency. Money was no longer tied to metal, it was tied to institutional credibility. The parallels with the medieval crisis are striking. In the 14th century, silver shortages froze commerce. In 2008, credit distrust froze global financial markets. During the COVID-19 pandemic in 2020, governments injected trillions into economies to prevent collapse. Instead of mining silver, central banks expanded digital reserves. Different tools, same structural tension. When liquidity tightens, economies strain. When liquidity expands too rapidly, inflation follows. The medieval silver crisis teaches that monetary systems evolve under stress. Bills of exchange replaced bullion transport. Banking networks reduced reliance on coins. Gold diversified silver. Paper replaced gold. Digital entries replaced paper. Each transition redistributed power. Those who controlled mines once dominated. Later, bankers gained influence. Today, central banks and global financial institutions shape liquidity conditions. The lesson is not that silver failed or that fiat is superior. It is that no monetary system is immune to pressure. Constraints force mutation. Mutation shifts incentives. Incentives reshape power. In the 14th century, those who understood credit instruments thrived while those clinging solely to land-based wealth struggled. In the 16th century, inflation rewarded some and punished others. History does not repeat mechanically, but it rhymes structurally. When money contracts, fear spreads. When it expands too aggressively, confidence erodes. Stability requires adaptive institutions and informed participants. Medieval Europe ran out of silver and reinvented money. Today, we are not running out of metal, but we are constantly redefining value through digital currencies, central bank policy, and shifting global reserves. The story of Europe's silver crisis is not ancient trivia. It is a reminder that money is negotiated, managed, and perpetually evolving. If you assume the system is fixed, you become vulnerable to its changes. If you understand how monetary stress reshapes economies and redistributes power, you gain perspective and perhaps an advantage. History does not hand out warnings in advance, but it leaves patterns behind for those willing to study them. If this gave you the new perspective, hit subscribe. History has the answers,